open question, Amrita, with all that's going on. What is a significant paragraph in the note you're going to write this week? What's the thing that you're really studying right now?
Two things I'd say, Tom. First and foremost is around recession. I do think while there's a lot of fears around exactly how the recession is going to pan out, what it means for oil demand, for us, the critical thing to highlight is that Asia, and I know you and I have talked about this a lot of times, China's reopening. I really do think recession, or at least a mild one, is actually priced in. If you look at December 23 Brent futures, we're at $90. Nobody's talking about what if demand holds up a little bit better. What could prices then do? So we are looking into that. And then, of course, on the supply side, we've got the strikes going on in Norway, the Libyan outages. But, you know, we've got some seasonal pressure coming through as well.
Are the responsivenesses, or the fancy word elasticities, of natural gas the same as oil? Is the elasticity of Netherlands nat gas like Brent crude?
So I would say on the industrial side, well, let's start with the consumer side. On the consumer side, absolutely not, right? Because from a consumer point of view, natural gas, it's electricity, which basically means that you are absolutely going to require it, particularly for home heating during the winter. Whereas arguably you could drive less unless and until you have to drive to work, right? So from a consumer standpoint, elasticity for gas it's even more inelastic than oil. Industry, however, we have already seen, if you look at Germany, Netherlands that you talk about, they are dialing down a lot of the gas consumption simply because gas prices are so high. Our models already build in some significant demand destruction in Europe because of high gas prices. And the risks to gas prices are actually to the upside, given what went on with Freeport in the US, lower LNG from there. If Chinese demand picks up in the winter, you could see even less LNG come through to Europe from the Middle East as well. So again, risks, just like you guys were talking about, is absolutely to the upside when it comes to TTF prices in Europe.
I will, Tom, I will see your elasticity and raise you a fungibility. Why isn't natural gas as fungible as oil, Amrita? We see such a huge difference in the price here versus the price in the Netherlands. Why aren't they as interchangeable?
Oh, absolutely. Great question, actually. It's just for the simple reason that oil has always been a more global commodity. Remember when the U.S. used to not be able to export crude, we had WTI trade at $20 discounts to Brent, right? That's when it wasn't as fungible. Now, with exports allowed, again, ultimately the price will dictate flows, whereas gas is slowly getting there. It's been more regional markets. And even right now, the U.S. doesn't export as much gas as probably it could do at these current prices. And then, of course, you've had the outages at Freeport. So that's the big problem and the difference in gas. It's always been more localized markets, Middle East supplying Asia, Russia supplying Europe, and kind of U.S., its own little market, U.S. and Canada.
I want to ask also about the competing calls on oil this morning, Amrita. City, of course, $65, which makes sense if we have a deep global recession. On the other hand, J.P. Morgan is saying it could go as high as $380, which is, you know, an eye-grabbing headline. But what Natasha Kaneva puts behind that, I think, is even more interesting. She says, this is the J.P. Morgan analyst, that given Moscow's robust fiscal position, they can afford to weaponize oil and just pull 5 million barrels a day off of the global market. Do you think that's realistic?
We actually don't think that's likely because so far we still see Russia acting as a rational player in the market, both for oil and for gas. It doesn't mean that energy doesn't get weaponized. I mean, particularly in the winter, more so for gas than oil. We could see that, but definitely not our base case. But I think in both cases, what I will highlight is that these are very eye-grabbing numbers precisely because, you know, you guys are talking about it. It makes the media headlines. I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90 because of years of underinvestment. Look at the US at $120, $110 WTI. The Dallas Fed survey, all it talked about was labor shortages, equipment shortages, and steel costs. Nobody's actually able to raise production very much. So that's on the one side. If Russia were to actually cut 5 million barrels, but it doesn't even have to do 5, it could do just 2 or 3, given how tight the market is, you can literally pick a number. I mean, 380, it could be 4 something, it could be 2 something.
Well,
I mean,
Amrita, just to jump in,
in
because
a
we only have like
territory
20
that we've
seconds.
never been before.
So forgive me. Could the global economy tolerate anything with a 3 handle once you get to 200,
No,
300?
absolutely not. We would. No, absolutely not. I mean, then the only reaction has to be a very, very deep recession, and oil demand has to collapse by 5 to 8 million barrels per day to even balance this market.